No hospital wings are named after indexers. Concentration is the path to real generational wealth in the stock market.
This is professional investor Karl Kaufman. He's achieved annualized returns in excess of 22%, and I brought him on the show to teach us how to build a generational income through investing.
Earnings are an opinion, and cash is a fact. A good accountant for a company, they can hide things. It's hard to fake the cash on the balance sheet.
Karl took over his father's portfolio, and in the show today, he's going to teach us how to build a portfolio that we can hand down to our children.
Common advice is to diversify. For me personally, I believe in concentration. 90% of my portfolio is in 3 stocks.
With the stock market, you can build an asset that will create generational wealth for your family. Stick around and Karl will teach you how.
If you're building a portfolio that's going to be a generational portfolio, you think of what's the company going to be doing 10 years from now, 20 years from now. Watch for big drops for little reasons. If you really want to build generational wealth, you need to...
People say that cash is king, but what we've all found at some point in our lives is that cash runs out. So what families actually need is a means to generate a perpetual cash flow, and one of the best ways to do that is through investing, and specifically income generating investments. So I brought Karl onto the show today to talk about how to build a portfolio that generates an income, not just for us, but for the future generations of our family. Now, Karl's a business owner, he's a professional investor, so he's very well versed in how we can build these income streams through investing in order to hand these down to our children and build a literal generational income. So thanks for coming on to the show today, Karl. I appreciate your time.
Sure, thank you, Ben.
Now, one of the first things I thought it'd be good to jump into, and we're going to go to kind of 0 to 100 here. If somebody wanted to begin building a portfolio that's going to pay them out monthly or quarterly, where do they start?
I always recommend to start with index funds as just a bare bone basic education in buying stocks. The S&P 500 in the States is the easiest one to get involved in. It's the 500 biggest and best companies in America, and they pay out a little dividend every quarter usually, and they have 500 great businesses that historically has returned about 10% over time for the last 100 years or so. So slow and steady wins the race with this one. I suggest, and I do also, just put some money in every month and just let that compound over time. And that's just a great way to get started, especially if you don't know anything about investing.
So one of the things with the S&P 500 is people typically buy into it more from a growth perspective. Would you say that having that growth is part of an income strategy, or is there a difference between having income stocks versus something that's focused on growth?
Sure. It's usually a good idea to combine both. You can think of a growth stock like Nvidia in the current market, or you can think of an income stock like, let's say, Procter and Gamble, which makes consumer goods, right? And they pay out a dividend every quarter that is just a little piece of their cash flow that they're rewarding shareholders with over time. So I love a good dividend. It means the company is mature. It's been around for a little while. It rewards its shareholders. And the best companies are the ones that grow their dividends. So you get some growth with the dividend, as well as on the other end of the portfolio, you can have more of the growth names, the Teslas, the Nvidias of the world, which are growing at a faster pace. And then you can sell them if you want to get some capital appreciation that way.
But what about like the tax aspect? Is from a growth perspective, is that more advantageous tax wise, or is there not that much of a difference?
Well, dividends are taxed as more favorable for investors because the company, the business that's paying out the dividends already is paying taxes on their earnings and so on and so forth. So as a way of thanking you for the double taxation, at least in the United States, dividends, qualified dividends are usually taxed around 15%, sometimes 20%. It's not taxed like regular income. It's a more tax favorable way of getting that income in your portfolio.
Well, that's really cool. So when they talk about the dividend payouts, which for those listening, say it's $100 stock and it pays a 5% dividend, if you're lucky, if we got all be so lucky, that would be a $5 payout per annum. That is. So when they say 5%, is that based after tax or before tax, or does it vary by per company?
It's usually just before tax, I'd imagine. You just get for in your example, you get the $5 in your account, and then you have to worry about paying the taxes later.
That's the accountant's problem, eh?
Exactly. Yeah. Talk to your professional team there.
Yes. Yeah. So okay, so let's say somebody wants to start building a portfolio that will generate an income enough to retire themselves, retire their wives, or maybe open up some more opportunities for them to subsidize running a business or something like that in the future. How do they identify what kind of target they have to hit in order to reach their desired income level?
Well, you have to do some math. AI or your ChatGPT makes it a little easier to figure that out these days. So you can say, I want to retire by, in 20 years, let's say, and I want to make $100,000 in dividend income, which is truly passive income. If you're just investing in the stock and they're paying you 4 times a year, that's not bad. Nice work if you can get it, right? You're getting all this money coming in. So, you know, not every stock is going to pay a 5% dividend. So you're going to need a big portfolio to get that kind of income coming in. A lot of the people who preach about dividends uh, conveniently leave that out, right? That you do need to grow your portfolio substantially. That's not to scare anyone out of doing that, but the sooner you start, the sooner you can build that portfolio by putting more and more cash in, and then that compounds over time. You get dividends from the stocks. You can reinvest it in that stock. Although I prefer to hold on to the cash myself, have control over the cash, and wait for a better time sometimes to buy that stock or a different stock that also pays a dividend.
Okay, so when you're focusing in on stocks, and are you more into individual picks and trying to time a good entries for them, or do you prefer to go for funds like mutual funds or ETFs or things like that?
Personally, I don't use funds. I have the index
Okay.
funds just as a way to set it and forget it. They're very, very cheap. One thing you need to look out for when it comes to funds, especially mutual funds, are the fees. The fees are basically a tax that you're paying to your fund for the privilege of managing the investments for you. And most active mutual funds do not beat the market over the long term, which is why a passive index fund strategy is usually a preferable way to go for someone who wants to just put money in and not think about their investments. Personally, I spend every day looking at the market. I love it. I'm passionate about it. And I'm constantly researching and thinking and looking at my stocks during the day. So I then, identify which companies I think are the best options. And for me, I know that common advice is to diversify, which is very good for most people who don't have the time or the inclination to track their portfolio. For me personally, I believe in concentration. So 90% of my portfolio is in 3 stocks. And then I have some other
Okay.
smaller positions that I add to over time or that they'll grow over time because I think they're going to appreciate in value.
That's quite an unusual approach. Like most of the time when you hear investment guys, they always talk about diversification, and that's why people like funds. It's because they put money into one thing and then they buy 500 in the case of the S&P 500. So do you think that in terms of turning this into a real business or a real engine to drive income for a family, that specialization and concentration into a particular set of stocks is the better path to go?
Look, it depends on what your goals are and how interested you are in tracking it. There's a quote I love that says, no hospital wings are named after indexers. They're all named after someone who took a concentrated bet and wrote it as it accumulated up. I'm not doing the quote justice, but you get the gist of it. So if you really want to build that generational wealth that you talk about, then you need to go, you need to really have conviction over a small amount of stocks. Because if you just sprinkle $1,000 here, $1,000 there, $1,000 there, if a stock goes up 5x, you're not going to your $1,000 is just going to be $5,000, which is nice, but is not life changing money compared to if you put $10,000 into one stock. The caveat being that you need to focus. There's more risk there if you just do it on a whim, right? If you just pick a random stock or you don't do your own due diligence. So I say cautiously, concentration is the path to real generational wealth in the stock market. An index fund is great when you're starting out to get your feet wet, to see how the market works, to get used to the ups and downs. But concentration is the name of the game. Warren Buffett as a great example. Warren Buffett said that 90% of his net worth is from 10% of his stocks. So you could have a lot of losers as long as you pick one or two really good winners along the way.
I think Bryce's law definitely applies. So in terms of when it comes to turning this into a family business, obviously what we would like to be able to do is to bring our children into it. Do you think that the art of investing and making good picks and specializing down is a skill that can be taught?
It can be if you make it fun. And I try and play a little game with my kids. My kids are 6 and 5 right now. And, they don't really understand that whole concept of stocks. What does daddy do? He plays with stocks all day. What does that mean? It's not tangible. But when we're out and about and they say, look, everybody's looking at their phones, I say, yeah, that phone is made by a company called Apple. And what daddy does is daddy buys little pieces of that company, little Apple slices, and that way every time someone buys an iPhone, daddy gets a little tiny piece of that profit from that stock. So I think when your kids are very young, you have to gamify it in a way. You could use like a candy store example or a lemonade stand or something that they can relate to, and teach them the art of putting money in to make it grow as opposed to just spending it on the candy itself.
Hey, I'm glad you're enjoying the video so far. Do me a favor and hit the like button, it helps me out a lot. And remember to subscribe so you don't miss future videos like this. Now coming up, Karl's going to teach us how to grow wealth while simultaneously building income. And he's also going to give us the steps that he would suggest in order to begin building a portfolio like what he has. So stick around and let's get back to the video. When I was younger, I was more of the spending it on the candy kind of guy
Totally.
than I was owning the gumball machine, let's say.
Right.
But so in terms of the different kinds of assets that we can buy and put into our portfolios, what are some of the options? You mentioned dividend stocks, but what are some of the other options that we might be interested in terms of what's available on the market?
Yeah, I mean, gold is in the headlines because it's been run up so much. I'm not a big fan of gold to begin with. It's an asset that doesn't provide income, right? You don't get dividends from gold. It's just a metal bar that just sits in a safe deposit box, really. You could buy, let's say, a gold miner stock of the company that mines for gold. But, for me, that's not something that I'm interested in. It's not really an income-producing asset. I do own a little bit of Bitcoin, again, it's a small amount of my portfolio just to have a little bit of action there. But again, just like gold, Bitcoin is not something that's going to produce income unless you're trading it. You're buying and selling Bitcoin on stock exchange or Bitcoin exchange. There are also REITs, which are real estate investment trusts. That's an easier way of getting into real estate where you don't have to deal with tenants who are humans, unfortunately. You can, kind of pass that off to somebody else who manages the properties, whether it's warehouses, commercial real estate, uh, cannabis companies that do the warehouses for cannabis growing. There's REITs for everything, malls, whatever. And so REITs are good because they have a special structure where they're required to pay 90% of their earnings, their profits, out as like a dividend of sorts. So a lot of people use that. With interest rates, REITs can be a very, an up and down kind of investment. One thing to keep in mind with all of these is the taxable qualities, like we discussed the taxes. So I own a lot of my stocks, especially something like a REIT or a dividend in an IRA account, which in the States is basically a tax advantaged account. There's no tax consequences on buying or selling or getting a dividend within the IRA itself until you actually withdraw the funds from that when you retire. So it's a very nice thing that we have here as a tax advantaged account.
So that's something that can compound over time as well. So instead of paying the tax now, you pay historic tax. Is that right?
No, I mean, so let's say you buy Apple for $100 and you hold it for 20 years and it goes up to $1,000. When you sell it, let's say you want to sell it and take the whole $1,000 out, then you would just get taxed on the $1,000, not anything along the way, not any of the dividends that have accumulated and compound and use the
Okay.
cash for something else. It's just dollar for dollar. That's on a traditional IRA. There's something called a Roth IRA, which is like the greatest wealth tool, at least that we have in the United States. I don't know what it's like in New Zealand, but we have a Roth IRA where you pay taxes up front. So let's say I would put in $1,000, and if I'm in the 20% tax bracket, I'd pay the government $200 right up front, and then the remaining $800 that goes into that account, uh, they never touch that. There's no taxes on that ever. So whatever accumulation. So let's say I buy $800 worth of Apple. Let's say I bought it, right now at $800, and that accumulates and that goes up to $10,000. Right when I sell it and take the $10,000 out, there's zero taxes on that at all. It's amazing.
Wow, that's the cleanest explanation of a Roth IRA I've ever heard. That
There you
sounds
go.
great. I'm
But
sold.
Ben, it gets even better, Ben, because you can pass that down to your kids when you pass away. You can pass that down to your kids, and they don't pay taxes on that, and they can leave that for compounded growth for an additional 10 years after you die. At
Wow.
which point,
Okay.
then
And
they have to take the money out, but they don't get taxed on it either.
okay. And then I suppose they can put it into their own Roth IRA and then continue the compounding from there.
Exactly, exactly. These are the secrets that wealthy families use to pass down wealth um, over time. And the nice thing about the Roth IRA is that the dividends that you receive, the buys and the sells, you don't pay taxes on at all.
That's incredible. Is there like a limit on the Roth IRA or no limit at all?
Well, the laws are always changing, and of course, I recommend everybody consult with a CPA, accountant, before doing anything. I'm not a tax professional, but there's a limit based on income, and I think depending on your age, you could put in, let's say, $6,000 or $7,000 a year now. If your kid has some taxable income, or if you have a family business and you put them on the payroll, you could pay them something. Then you could start a Roth IRA for them, and then you can put in a certain amount of money and let that grow over time. So there's that limit to what you can put in, but not to confuse everybody too much. There's something called a backdoor Roth IRA conversion where you take the money you have in a traditional IRA, you pay the taxes, then you can convert the traditional IRA to a Roth IRA, pay the taxes now, and then that grows tax-free forever.
Can you have both at the same time?
Yeah. Yeah, I have one of each. And
Wow,
and
okay.
slowly over time I do some conversions, some traditional IRA conversions.
In terms of starting out and building our portfolio, what are some of the ways that we can minimize stress? So let's say somebody has gone ahead and found their picks, and we'll get into what qualifies a decent pick later, but what's a way that somebody can begin to build their portfolio? Are you a big fan of DCA, or that's dollar cost averaging for everyone out there? Or should they automate it, or do they hold off and wait to time the market?
It depends on your risk tolerance, your time horizon, everything that an advisor would say. I would repeat at the beginning as a disclaimer, right? You have to know thyself as an investor, as you would in any other facet of your life. If you're someone who frets and worries about everything, and you can't handle to see your portfolio drop, 10%, 20%, then, you shouldn't be in the market. You shouldn't have stocks, right? Find something else to do, because, the writer Hunter S. Thompson once said, buy the ticket, take the ride. So volatility is the price you pay for that appreciation over time, and not every stock is going to be a winner. Like I said, you may have 9 losers for every winner, but the key is to make that one winner 10 times more than those 9 winners. So you have to understand who you are. You have to work on your mindset. You have to, develop those healthy habits of, sometimes thinking against the grain. Whether for me it's concentrating instead of diversifying. One thing I like to do is I watch for big drops for little reasons. So to give an example, right? Today, Meta released earnings yesterday, right? Meta being the owner of Facebook and WhatsApp and Instagram, right? They are one of the biggest cash generating machines in the world, right? It's basically an ATM of free cash flow, right? Which we can go into later. That's my favorite metric to look at when it comes to a stock. So Meta today or yesterday released their earnings, and they said they're going to spend a lot of money on building out their artificial intelligence platforms, right? And by a lot of money, I mean like a lot of money, like 70 to $100 billion in building out this infrastructure.
Right, yep.
Okay. Now, the stock market, yeah, right? That's a lot of money, right? For anyone, especially, a big company like that still. So the company went down 10%, even more than that today. And, following that stock as closely as I do, I understand the management. I know that Mark Zuckerberg is one of the best CEOs out there in terms of capital management, in terms of platforms. Say what you want about him, but he is an excellent CEO. He knows what he's doing with that. So I also have a long-term time horizon, right? The market may throw a tantrum like it did today because they hear, a $70 billion capital spend, and they're like, wow, that's going to really affect their earnings over time in the short run. Whenever I buy a stock, I think about like what it's going to be 5 years from now, right? And if you're building a portfolio that's going to be a generational portfolio, you think of what's the company going to be doing 10 years from now, 20 years from now, if it's still in your portfolio. But, a day like today is just like a perfect buying opportunity, in my opinion, for one of the world's premier companies.
They say, what is it, Mr. Market's supposed to be 100% efficient, but there's definitely human sentiment that's still baked into that, I think, especially around hot topics like AI. So, in terms of finding good metrics to measure, you mentioned free cash flow. How do we identify these qualities of stocks and use them to determine what a good investment is versus a bad one?
Yeah, I like to look at a few things, free cash flow being one of them. And free cash flow is the amount of cash that a company has on its balance sheet after all of its other things are paid out, right? Like, operating expenses and sales, the money that they have after they buy equipment and they pay their employees. There's just cash on the balance sheet that they can then do what they want with it. They can invest it into the company like Meta is doing. They can use it for share repurchases, which means that there are less shares out there. So your stake in the company actually grows. As little as it may be, it gets a little bigger. Everyone likes share repurchases. It's a lot more tax efficient for the company because they're not paying out those dividends. So they don't have to pay the taxes on that. So they can pay the dividends. They can grow their dividends. They can reinvest in the company. They can also invest it themselves. Berkshire Hathaway, Warren Buffett's company, is a classic example of that. They have an equity portfolio themselves. They have a huge stake in Apple and Bank of America, Wells Fargo, like other companies as well. And they can also use that cash to buy or merge with other companies. So free cash gives the company a lot of flexibility. My dad used to always quote the line, "Earnings are an opinion and cash is a fact." And, a good accountant for a company, they can kind of massage their earnings, right? They can play around with inventory or accounts receivable, or they can hide things that, unless you're really doing some forensic accounting, right, you're not going to catch as like a regular everyday investor. But it's hard to fake the cash on the balance sheet. So that's why that's my number one thing that I look at. What's their free cash flow? Is it growing over time? In Meta's case, their free cash flow is going to take a big hit because they're spending a lot on building out this AI infrastructure. So if I were to just look at, say, Yahoo Finance and see their 3 or 5 year free cash flow over the last few years, then I'll know that, 2025, 2026, there's a reason why their free cash flow is not growing like it was before. So that's why it pays to really study the companies and understand them, understand how management works, and so on and so forth.
So, whereabouts do we go to find this free cash flow? Is it something that they typically list on their profit and loss statement or balance sheet, or is it something that you have to go and work out yourself?
Yeah, this is all public information. When a company publishes its quarterly and annual results, they publish all this. So you can find it. Yahoo Finance is a good one, or there's a company called Morningstar, which has a few years for free. Seeking Alpha is another one. You can go straight to the company's website, or use an AI tool like ChatGPT. I always say with ChatGPT that you can trust but verify, because it often makes some really crazy mistakes with its data hunting and gathering. So I would ask it to triple check anything that it gives you, and look it up for yourself too.
So you mentioned also that share purchases or repurchases are a good indicator of a company's confidence in itself. So how do we find out if a company is buying more shares in itself? And for that matter, what about CEOs? If they're buying stocks in the company, is that a good indicator?
Usually when they announce earnings, a company will announce like a share repurchase plan. They'll say, the company X is committed to a $1 billion share repurchase plan, and the market likes that because it's a very tax efficient way of increasing their earnings. CEOs like that because it makes it seem like they're doing a good job. Oftentimes, though, you have to watch out for that because companies may not be buying their shares at a great price. If the stock has gone up a lot, well, then they're going to be paying a lot for those shares. I personally prefer dividends because then I can choose what to do with the cash. I always want control of the cash, of my own cash, right? So if I'm giving money to a CEO to manage my money for me, basically, within his company or her company, I want them to pay me back so that I can have control over that and decide, well, maybe the share is overvalued, so I want to use that cash for something else. I want to take my kids to Disney World with the cash, or put it towards their college tuition, or I just want to, let it sit and wait for a good opportunity to buy. Now, to your other point about insider transactions, there are many reasons why a CEO or an executive would sell a company. Maybe they want to take their kids to Disney World, or they need to buy themselves another yacht, or their share repurchase options program dictates that they need to sell stock at a certain time, or they just have a lot of it. But there's only one reason why an insider buys a stock, and that's because they think the stock's going to go up. They have faith in the company, and they think it's going to go up. So that's what I would track more than selling. I look more for insider buys.
I mean, they'd be the ones to know first before us, wouldn't they? But in terms of you said you prefer to have control over the dividends. Now, do you do dividend reinvestment plans, or are you a bigger fan of having the dividends paid out to you and then deciding to reinvest in the company or reallocate the funds manually?
Yeah, I'm an active investor, so I don't just pop the money back into dividend reinvestment plans. It's great for people who just want to keep accumulating positions in their portfolio. If you want a bigger stake in the company and you don't want to think about it, you just set up the DRIP, the dividend reinvestment plan, and the dividends just roll back into buying the stock. Just like with the share repurchases, uh, you don't know what the price of the company is going to be at that price. The stock may be expensive based on what you value the company at. So uh, in that case, you're getting less bang for your buck, if you will, because the shares are more expensive. That's why I prefer to have the cash and decide myself if I want to buy more shares in the company, if I want to hold on to the cash and wait for there to be a dip, perhaps in that company, a different company, or do something altogether with the money.
Well, you mentioned earlier about our time horizon if we're building generational portfolios, and maybe for an individual investor, you'd be thinking about it 5 years out, but if you're thinking about it as a family, you're thinking 10 to 20 years. Is it reasonable to have a longer time frame than that when it comes to buying a portfolio and thinking about 50 to 100 years? Obviously, very difficult to predict, but when we're purchasing a stock or a part of a company, is it reasonable to believe that it will be in our portfolios for 50 to 100 years, or is that far too long to be considering holding on to a company?
If you look at the top companies in the world from 50 years ago, I don't think any of them are in the top right now. Um, Maybe one or two, but I doubt it. I'd have to look that up, but maybe yeah, from 100 years ago, certainly none of those companies. Probably most of them are not even around. Look at think of a Sears, right? So with that kind of time horizon, if you're thinking generational wealth, it's hard to predict what's going to happen 50 days from now, let alone 50 years with the companies in your portfolio. That's why with an index fund, if you had just the S&P, if you just bought the S&P 500 100 years ago, I mean, you can, if you put in, I think, let's see, what was it? If you put in like $100 a month from 100 years ago, every month up until now, you'd have put in, let's say, 40,000. I have to remember the math, but $40,000, it would be worth $500,000 today, right? So, 10% a rise compounding every year, That's going to make significant wealth over a long period of time. But a more important thing than the actual stocks in your portfolio is to pass down the actual money habits and philosophies to your kids so that they can be good stewards of the wealth that you create long after you're gone. That's more important than any amount of money or any one particular stock or any particular investment. You have to let them understand why you invest, why you invest in the companies. Take the Apple example with my kids. But you have to basically good money hygiene. That goes a long way towards preserving, because I think the statistics are most family wealth is squandered within a generation or two.
So, okay, then, well, we've talked about some of the passing good habits. How do we avoid them falling into bad traps? If, speaking to your point earlier, if they didn't invest from, their entire life, they're going to, let's say they missed the first 10 years and they decided it was a better investment was buying a car that they'd probably total at some point. That wealth is not going to be able to compound. So what are some of the mistakes that people make with their portfolio, and how do we teach our kids to avoid them?
Well, I think one of the mistakes is that you just say, "Oh, I don't want to be bothered with this. I just want to, hand it off to a financial professional and hope that they do a good job and trust that they're gonna have my best interests at heart." That's not to say that a financial advisor can't help you out. I think they do tremendous work. I think that they are excellent for estate planning and tax planning and all kinds of stuff. But just because someone is certified as a professional doesn't mean that they are going to outperform the market or do a better job than you would, right? So my dad's favorite quote, besides earnings or opinion cash as a fact, my dad's all-time favorite is, "No one loves your money more than you," right? No one is going to care about your money and your financial health more than you will, right? No financial advisor, no accountant, no no attorney, whatever. They're not going to care about you and your portfolio more than you will. So most people just, like I said, hand their money off to a professional and say, "Oh, they know what they're doing. They're going to do this. They can't be bothered," right? They'll spend 100 hours buying stuff on Amazon and researching discounts on Amazon and planning vacations and trying to save $100 on a vacation, but they won't spend the time to look at their money, right? I mean, this is not to say that people are doing it wrong, but I think teaching your kids not to make that kind of mistake, to really prioritize their financial health, because I wrote about this last week, but there's the quote that money is the root of all evil, or the love of money is the root of all evil. But I think there's something to be said for loving money because you can do good with it, because you can pass it down to people, and you can make the world a better place with your money by giving to charity and starting foundations, depending on what kind of wealth that can accumulate. And for people to not prioritize it when it's, save for your health, it's the single most important thing that affects your daily life, right? Your financial well-being is the single most important thing, besides your health and your social network. Let's say your friends and family.
The only people who don't care about money are the people who have it. So
Right.
I think that's a pretty accurate statement for most people out there. So backpedaling a bit now and going more into how we grow and scale this portfolio. Do you think it's better for somebody to start out, other than once they've got their ETS and everything sorted? Do you think it's better for someone out to start out researching a field of companies, or like an industry, or to start looking at multiple industries and trying to pick the best stock that they can find based on its yield and its earnings?
Yeah, when my dad saw that I was starting to take an interest in investing, he gave me a copy of Peter Lynch's book, One Up on Wall Street, which I can't recommend enough for anybody with a passing interest in stocks. Anyone would benefit from reading this or rereading it. Uh, and Peter Lynch's famous maxim was, "Buy what you know." Right. So if you work for Apple, then you're gonna want to probably buy Apple stock. Or if you go to Starbucks, let's say, you drink a lot of coffee, you see a lot of people drinking coffee. That's not just I'll qualify that statement by saying you have to do the research to make sure it is a good investment, right? Let's say when Peloton was all the rage during the pandemic, and everybody was stuck in their houses, and Peloton was a gigantic stock. You could say buy what you know, and then people would buy Peloton, but then the stock collapsed because it didn't have the right foundation. It didn't have the good numbers that I research, and that anyone should research before they just go out and buy a stock. But I'd say the best thing to do to start off is to stick with industries, stick with companies that that you're familiar with, that have been around a long time, that are profitable, and are continuing to grow their profits over time.
No, that makes perfect sense. And well, speaking of growing over time, then, what about when we hit recessions or downturns in the market? How do we maintain that income and continue to grow our portfolio through that? Or do we just expect for our income to take a hit? What does that look like?
Okay, well, if you have a basket of dividend stocks in companies that, let's say consumer staples like Procter and Gamble, or let's say a tobacco stock, depending on how you feel about that. But tobacco stocks will pay out their dividends and grow their dividends regardless of the market conditions, right? These companies have been around for a long time. Procter and Gamble has been around for over 100 years. Coca-Cola has been around for over 100 years. They continue to pay out a dividend regardless of September 11th, the global financial crisis, World War II, the coronavirus pandemic, the COVID, whoever is in the White House. It doesn't matter. They'll continue to grow and pay out their dividend, right? It's not just paying out a dividend, it's also growing the dividend too, which is something that's important. So by having a basket of those stocks that are paying the dividends through thick or thin, well, then you can have some income to support you. You don't have to actually sell stock. Let's say you're a retiree. You don't have to actually sell stock to get the income, because the companies are actually, giving you the money regardless. For me personally, I like when the market goes down, because I get more for my money. I can, my investment dollars go further, and I look at it as like a sale. The stock market's the only place where the customers buy when everything's expensive and they sell when everything's on sale. So the key is to kind of think the opposite of what most people do, and that's the key to success, I think, in the stock market and in any field, really.
The typical advice is buy high, sell low, isn't it? It seems to be what a lot of people do anyway in retail.
Yeah, right.
In terms of that, purchasing into companies that will generate an income regardless of market conditions, what are some recession-proof industries that people could look into?
Well, consumer staples is one. It's not exactly sexy, but if you're Procter and Gamble, let's say, I don't own any right now, so this is not an endorsement for them. I did at one point, but just in general, let's say Procter and Gamble, regardless of whether or not there's a recession, people need to buy tissues and toilet paper and diapers. They're pretty well covered if the economy tanks. They have pricing power because I mean, you can go between Huggies and you can go between, the other Pampers. But other than that, you're still going to need diapers, no matter what. So those companies are pretty recession proof. But in an environment like this one, where everybody is excited, the stock market's at all time highs, those companies tend to, you know, not do as well relative to an Nvidia or a Tesla, where there's more froth, as they say, where everything's very excited and people are buying up the stock.
Really, if you're trying to build an income, do you want to be rebalancing frequently? Do you want to be shifting between industries to try and find that optimal yield? Or should you be chasing something that's more sustainable that will grow over time?
It's hard to time that perfectly, right? Even the best professionals, hedge fund managers, mutual fund managers, they get it wrong all the time. So they rebalance at the wrong times or whatnot. It's a very common and it's practical perhaps for some people. I'm not a proponent of rebalancing a portfolio. I don't know why I would want to sell my winning stocks and buy more of the losing stocks, just because of some arbitrary number. Um, for me personally, that's not something that I get behind. But I see why other people will do it. Whether it's a 60-40 portfolio where 60% of the portfolio is in stocks and 40% are in bonds. It depends on, like anything else, how much time you're willing to spend to do it and how much risk you're comfortable with.
Well, you mentioned bonds there. Do you find that bonds have a good place in an income-based portfolio, or are you more a bigger fan of stocks?
Yeah, I'm much more of a stock investor. I don't have any bonds in my portfolio. Uh,
Oh, interesting.
Bonds are good. Yeah, they're good for retirees who also just want fixed income, steady payments that way. But I don't I don't really do that. I'm all equities. That's something that I'm comfortable and familiar with, and that I know outperforms bonds over the long haul.
It's hard to see the point in bonds when you get the same yield and dividends, but you also own a piece of a company, and you're not just going to be getting back your initial capital; it's going to grow as well. So, I'm definitely with you there. But I do think that bonds can have a place in a portfolio at a
Yeah,
particular point in time, or should they just be avoided at all costs?
sure. It depends on the investor and how comfortable they are. Bonds provide steady income usually, uh, but very interest rate sensitive. So in the current environment, right, the Federal Reserve in the United States just lowered rates yesterday. So there's plenty of interest rate risk that goes involved there. I'm just someone who doesn't buy bonds at all. So for some people it works. It's nice. It's nice to get that income that way. You don't have to worry. Let's say you're buying United States Treasury bonds, then you don't have to worry about the U.S. government defaulting because they can always print money. So, that's all good. Some people like to buy, say, Apple bonds because the chances of Apple defaulting on their bonds are probably even less than the U.S. government because they're better run. So, uh, who knows? Who knows? But if you're into that, if that's something that's interesting, then sure, put it in your portfolio. But for me, it doesn't work.
So, in terms of giving up income, then, so bonds, let's say somebody has a portfolio of bonds, stocks, it doesn't really matter, but they're generating a decent income. When does it make sense for them to give up some of their income to invest in another asset, for example, a family home or into a business?
So I'll give you an example of myself. I built up a portfolio, and I wanted to buy my first house, so I needed some assets. I needed to sell some assets, right? I needed to sell some stuff in my portfolio. In that case, it made perfect sense to add that asset. I mean, the nice thing about a family home is you could live in it, and It provides shelter and a place for memories and stuff like that. But like bonds, real estate is not something that I deal with. It's a tried and true method for a lot of people, and it works for a lot of people. But if you're someone who likes it, who likes the challenge of buying real estate or land or commercial properties, then by all means, have yourself a portfolio of stocks and a portfolio of some real estate. I mean, over the long run, it's done pretty well. Um, for me, I have my house, and that's pretty much all I have for real estate. I don't really want to deal with tenants calling me at 2 in the morning for, let's say, a multi-unit property. I don't want to plunge anyone's toilet besides my own, and that, or find someone to occupy a space that I may have had that the tenant moved out, or wreck the place. Right? I've heard plenty of horror stories of tenants moving out and wrecking places. So real estate is great for a lot of people too. Uh, like anything else that we've discussed, it depends on your time, your inclination, your interest, and your curiosity.
Good answer. Good roundabout way of. I'm not giving you one too. But we're coming up on time now, so I really wanted to
Yeah.
construct something where somebody can begin today. So, what are the first three steps that somebody could take this week in order to start building a portfolio?
Okay. So, I mean, the easiest thing right away is to commit to becoming an investor, right? And say, I'm going to have the mindset that I'm going to be an owner. I'm not just buying stocks like they're lottery tickets. I'm not just going to a casino. I'm going to be an entrepreneur, have that kind of mindset. And I'm going to think that I'm going to own a little tiny piece of one of or some of the world's greatest businesses. Okay. So the first thing is just, develop that mindset and think that, this is not a lottery ticket. This is not a casino. Okay. The next thing I would do is open up a brokerage account and commit to whatever you can afford to put in every month into an S&P index fund. So, there are a whole bunch of them. It doesn't really matter. Just make sure the fees are very low. You can pay, for $1,000, you could pay, 3 cents or $3 or something like that out of $1,000 investment. You shouldn't be paying any more than that. But the key is to automate it. You can go to a broker like Fidelity or Schwab, or it doesn't matter which one. You can go sync it with your checking account and say, I want to take out $5 a month, $100 a month, $1,000, whatever you can afford. You're paying for a Netflix subscription. At least do what you pay for Netflix each month, right? And automate it so it goes out of your checking account right into this account and buys the shares of this index fund, right? This is going to take yourself out of the equation. So whatever mindset you had that you may have developed in step one, it doesn't matter for now because you're just taking yourself out of it. You're saying, I'm buying, let's say, $100 a month in the stock market through thick or through thin. The market may be at all-time high. I'm still buying. My money goes a little less. There may be a recession and the stock market is down 30%. I'm still buying, right? It doesn't matter. My money goes further that way. I'm getting more shares that way. And if you don't see it in your account, you can't spend it. And so you basically are just taking yourself out of it, automating it. The money is going in and it's compounding and it's growing over time, right? Set that up. So it's literally set it and forget it, right? Because then don't touch it, right? Don't touch it. Don't do anything with it. The last step would be to start looking at the items that you're purchasing and think about the companies that may be making some of these things. So I use my Apple example with my kids. Another thing would be Amazon. Let's say I use Amazon all the time. I tell them that their toys and stuff comes from Amazon, right? If you're in the States, I don't know in New Zealand, but in the States we have Black Friday, where the day after our Thanksgiving, all the stores run giant sales, right? And everybody spends a lot of money, whether it's probably for Christmas gifts in advance, right? So let's say you buy a new iPhone for your loved one, and it costs $1,000. If you have an extra $1,000 and you've done the research, you think Apple is a great company, then take that same amount, that same $1,000, and put it into Apple stock when you buy that phone. And this way you're going from becoming a consumer of the company's products to being an owner of that company's products and feeling a little better about that $1,000 you shelled out for that iPhone.
Yeah, that's a great way to go about it. And so essentially what you're saying is you take the mindset of an owner, so you're understanding that you need to learn and research things. You open up a brokerage account and start building up a dollar cost average into an index fund. And you're kind of building, would you use that as like a war chest in order to reallocate funds into individual stocks? Or should the purchases come directly from your bank account when you are buying individual stocks?
Yeah, you could do it however way you choose. I put the funds in a money market fund, which pays out interest while the funds are sitting there until I'm ready to buy something and I find a good opportunity. So the money market fund will just collect interest on the funds that are there, as opposed to a checking account in bank, which pays nothing. I'll put it in a money market fund. It's very liquid, so you can take the money out at any point and put it right into stocks, or if you need it for an emergency fund, you can take it out for that also.
Okay, so money market funds. Is that something that's held with a brokerage account?
Yeah, a brokerage account. And, ChatGPT makes it easy to do the research to figure it out, how to go about doing it, and, what are they usually have like ticker symbols that are similar to stocks. So like Fidelity one might be, if you have a Fidelity brokerage account, you type in Fidelity money market fund and it'll be like FSTX or something like that. Don't quote me on that exact ticker, but it's something like that, and it'd be a Fidelity money market fund. If stocks, if interest is at 4%, it might pay out 3.75%. So whatever it is, it doesn't really matter. You're making some money on the cash that's just sitting there, as opposed to being in your bank account or under a mattress, where you're losing money to inflation.
So a money market fund is something you buy like a stock. It's not like a bank account held with some brokerage.
Yeah, it's like that, but it's very liquid. So, for instance,
Okay.
I would have it in my brokerage account. Let's say there's $1,000 in that money market fund, and I want to buy 1,000 shares of Apple. I would just, put an order in to buy $1,000 worth of Apple, and it would just go directly out of that money market account. I wouldn't have to put new funds in unless it was more than what I had in there.
Really, really interesting. It's a great way to get started as well. So somebody's able to get some action, earn a bit of income from it, and then start building up this portfolio of things that they're actually aware of and can learn more about in order to create truly an asset that will last their family or provide for their family and potentially last generations if they're willing to understand that maybe some of the big companies today aren't going to be around in 50 years. So I've really enjoyed this chat, Karl. I think it's been very enlightening. I've learned a lot, including the most succinct description of a Roth IRA I've ever heard. I mean, they sound like such a complicated thing to me. We don't actually have tax on stocks here, which sorry, not to make you too jealous, but you don't pay tax when you sell stocks here, which is
really.
very handy. Yeah, very handy. But so it makes things simple in a lot of ways. But it's also
Yeah.
I'll get into it another time. I'll tell you about it another time. But we're coming up on time here. So one thing I've heard you mention a lot is your father throughout this whole thing. And he's really taught you a lot. So if there's one thing that you would say now to honor your father's legacy, that some wisdom that he would want to pass down to all the listeners out there, what do you think he'd say?
My dad and I formed the business together at the later years of his life. and it's a way of educating people how to take control of their own money, right? And he taught me everything that he knew. I spent tens of thousands of hours at his side watching stocks, right? It helps to have the same passion as your child and as your father does. So I learned a lot from him, and he taught me those money habits, which I mentioned before, which I plan on passing down to my kids also. And that's the real key to generational wealth. So, my father died 5 years ago, and his portfolio that is in my mom's name now is still generating income through all the dividend stocks, right? So it it's a way of when you think about what you want your family to remember you by when you're gone, money is money. It's not the most important thing as far as your legacy. It's nice to set your future generations up, but the key is to teach them wisely how to manage the money so that they can do it themselves without you in the picture.
That's beautiful, man. I think that you're on the money there. Not to be too punny, but no, that's beautiful, man. I think that's a great legacy to leave. Not only
Yeah.
being able to provide for your
Yeah.
family after we're gone, but being able to help your children provide for themselves as well. So, thanks for coming on today, Carl. It's been very enlightening, and I've really enjoyed our
Right.
chat. We'll have to do this again sometime.
Absolutely. Thank you, Ben. This is great.
All right, take care. Hey, thanks for sticking around to the end. Really appreciate it. I'm going to leave links to learn more from Carl in the description down below, so go and check that out if you want to learn more from him. And speaking of learning, education is a really important part of building your legacy. We teach who we are as much as what we know. So to make sure that you don't lose your kids, it's really important to implement at least elements from homeschooling. So I interviewed Alec Griffith, who's an expert homeschooler. You can go and check out this video here where he talks about implementing elements from homeschooling to raise the sophistication and capability of your children. Good interview. Really recommend you go and check that one out. And I'm going to get YouTube to leave a video here that I think you will like next. So check out either one of these two, and appreciate you sticking around to the end. Remember to like and subscribe, and I'll see you in the next one.